Is stocks over or undervalued? Hey, welcome to Dow Stock Talk. In this particular video, I'll be going over whether the market is undervalued or overvalued.
Okay, in this video, we're going to see if the market is overvalued or undervalued. And I looked at different types of models where you can see whether it's overvalued and undervalued. And I'm going to explain the whole logic. Some finance YouTubers, as far as the big ones, as far as whether the market is overvalued or undervalued, they look at the Buffett indicator, S&P 500 PE ratio. If you wanted to see more in-depth videos of ways how you can tell if the market is overvalued or undervalued, make sure you check my suggested videos. I kind of give an explanation off of all of that. But in this one, we're just kind of really going to focus on the data. So as we can see, the S&P 500 PE ratio is 21. Now, if we look at historic levels that's tracking it all the way back to the 1800s, we can see the mean is 15.99, so it's above that. And we have for the median is 14.91. So some people would look at that and be like, well, it's higher than the mean, so therefore it's overvalued. However, everything is relative, and I'll explain this later. And also, someone may argue that, okay, based off of levels from the Buffett indicator as well, it's showing that the market, if we kind of look all the way back, the market is overvalued. If we kind of looked at these numbers based off of the longer, taking things back 50 or 60 years, as we can see, the value is for 75, very undervalued, fair value from 99 to 120. This is kind of a lot of times Buffett made a statement back in 2001, a long time ago, saying that as far as index percentages, as far as moderately overvalued, 121, 143, slightly overvalued, more than 143. So as for example, the Buffett indicator today is 154, so it would be significantly overvalued. However, you got to remember where this chart is going back. Now, also you got to remember from a practical sense, if you was basing it off of that, the last time it actually hit the mean was probably around, let's say, 2013. So we're looking at almost 10 years. So this data has been saying this for over 10 years. So you got to really think about it. Is this still a good way to assess it? And I've concluded that not really, because it's not really telling you much, because in the past 10 years, it didn't really tell you much about it. And plus, with the Buffett indicator, it's going to still, we know that there's a problem with it because 40% of the earnings comes from overseas, and a lot of it doesn't include public companies, so that definitely kind of screws it. So but that's why if you ask like some finance YouTubers or something like that, just looking at historic number on the surface, based off of when people were saying it was overvalued for, a long period of time. So that really doesn't give me insight. So what I particularly did, I looked into the data closely and I looked at more recent numbers, and then you can see when you're looking at more recent numbers, the past 20, 30, 40 numbers, the numbers tell us otherwise. So let's go. And oh, by the way, if the same thing for the Shimmer PE as well. Shimmer PE supposed to be a little bit more accurate, adjusted for inflation and like secular businesses, so therefore it kind of smooths it out. But the numbers are still roughly the same. Currently, we're at 28, the mean 17, the median's 15.91. So I'm just showing you where most people would make the argument that the market is kind of overvalued, and that's where they're probably getting their numbers from. But if we look at, and I think when you're looking at this market nowadays, it's good. As we can see, it rarely ever, let's go back to the chart because let's really dissect it. It rarely ever is really at that one, two, three, four, five touches. Like, so a lot of times it has been below it or above it for long periods of time. So, and also if you notice recently, we can see there's been an upward trend. Also, you have to keep in mind that interest rates back then was much higher, so that would make stock evaluations much lower. So if interest rates are lower, typically stock evaluations are going to be higher. So you got to put things in perspective. Now, keep that in mind. And by the way, I'll do the points for as overvalued and undervalued so I can show you why I'm using the particular data that I'm kind of using. So this is a more, it's like a valuation model where they're looking at the Buffett indicator, but they're looking at it with an upward trend line because we seen over the period of time as far as let's go back to the Buffett indicator the Buffett, it has been trending upwards since the 1980s. So that's why it's a good way that when I'm looking at it, I'm looking at the drawing an upward trend line. And by the way, we're looking at, I think a best way to better assess it is to look at a standard deviation plus or minus one, because it will give you a better indication. Because a lot of times it's above the mean or below the mean. A lot of times it doesn't actually hover on that. So remember, that's the average. So when we're looking at average, I think the key thing for valuations as far to tell us relevant information now is to look at ranges. Now, as we can see right now, the Buffett indicator, this is maybe a little bit older. It says February 24, something like that. So it's about 163. I think the other one actually might be lower than that because this is an older date. So I think it's probably maybe about like 150 now or something like that. But as if we look at the chart on the a more recent one, we see that it's about 50. Yeah, so as of now, here we go. As of now, we're at 152. So let's go back to the this is the historic trend line right here. So the historic trend line is 26% above the historic trend line. But when we're looking at overvalued or undervalued, we're really paying attention to this green line. So what's the undervalued line? And this is average. This is I want to say closest to this one. This is more so like the undervalued stage. And this is, but when it gets above this one, that's when we get into overvalued territory. Now, one can argue if it's just historic low, below the historic, we can just say that it's undervalued. But and once you get to the minus one, that's kind of like really undervalued paste of it. So one way you can look at it, if it's below the historic trend line, you would say it's undervalued. It's generally, if it's above, it's overvalued. But when we really looking at it from a practical sense, as you can see for a long time, that they kind of hover within the range. So the minus one plus one range. So as long as it's within that from historic line to plus one range, I would consider as fairly valued. Now, as you can see, it's creeping up close to becoming overvalued, but right now it's still in the fair value range, and that's why they end up still having fairly valued. Actually, this number now is 152 as of March 1st, so it would be, slightly a little bit lower than that. So far as the Buffett indicator, we're saying it's in fair range. Also, you have to remember like 40% of the S&P earnings comes from overseas. So we already know that this isn't maybe the best to look at when we're assessing this. But so for one right now, we got one for fairly valued when we look at the Buffett indicator. Now for the PE ratio, I'll go over this one as well. So for the PE ratio, when I looked at this, when you're looking at for the past 40 years, the average PE, I got about they say it's about 19.6, but I got about, I'm not exactly sure where they're taking it from, but from the 40 years I got personally 21, and for the shimmer PE, in the past 20 years I got about 26. So as they're saying for the past 10 years, as far as, and by the way, they're using this number 28.3. They're using the shimmer PE. So just I confirmed that they're definitely using the shimmer PE. Is 28. Yeah, so it's right now it's 28.63 right now. So we got 28.63. So let's go back. Yeah, 28.63, about same like how they have it. So this one they have, like I said, they have it as slightly overvalued. Now, this is one of the things I'm looking at. This is only one particular chart, but as you can see, even if they consider it overvalued, it's slightly overvalued or whatever, if we're kind of looking at that. So one could make an argument of that. However, when we looking at let me see, the modern range, from like I said, it's very close. So if we look at another particular site, which I think they kind of do a better job as looking at everything overall. And they look at the PE average over the past 40 years, they got 21.92. If they also mention historic levels, if you base it off from 1900 to 1980, 13.34. But if you're looking at over the last 40 years, we see that it was 21.92. So they're just kind of showing you that, and they're also showing you, the overall chart, and how they assess it. Now, I've kind of looked at this and did some more personal research, and I think this one is pretty accurate. I like how they do with the gauges level. So as you can see on this one, they have, as far as P shimmer ranges, a fairly value 20 to 30. From my personal experience, as what we've seen recently, I think this is accurate. As far as the forward PE, that's estimate, so 20. And as far as the PE, we have 21. So even though for the shimmer PE it's close to undervalue, it's still within ranges of fair value. With that being said, I counted it as fair value. The PE, forward PE, and shimmer PE, which is 3 and 1, suggests that it's fairly valued. Even though it's on the high fairly value, it's still within normal ranges. So that's how I concluded. You can make an argument about it. That's why I concluded, as far as the PE ratio, that it's fairly valued. So PE one, this one has slightly overvalued. But when I'm looking at it, I'm looking at them. I'm looking at, to me, the a better indication of that is looking at the PE, the forward PE, and the shimmer PE all together. And the data is telling me all together, based off of the modern numbers, that it's still within the fairly range. And I like the way they broke it down and kind of assessed it. So for the PE ratio, I'm going with fairly valued, even though it's still higher, closer to the higher side. But I'm going with the fair value because I'm looking at all three of them together. So for the Buffett indicator, I have fairly valued. They just looking at the shimmer. I'm looking at the PE, shimmer, and forward PE. So that's how I got fair value. You can argue that whether yourself. The next one, we look at interest rates, and this model looks at stock prices relative to interest rate. So as we see historical interest rates, we look at the historic levels. And by the way, I'm looking at the like yellow line. I would consider overvalued. If it dumps down, fair value, as they can say, is from this range to this range, and once it goes to the green, that would suggest light green. That's what it suggests overvalued. I mean, that's why when I'm looking at the standard deviations, I'm looking at the +1, -1 range. So, and they kind of group it as fair value all the way in between there. So if we're looking at stock prices relative to interest rates, as we can see, it falls in fair value, hovering around that historic trend. So we can see it's fair value if we're looking at this. And remember, that's why I think when you're looking at, I think it's much better to look at the standard deviations to pick whether the market is overvalued or undervalued. So for interest rates, relative to S&P relative to interest rates, we have fair value. Now, if we look at the yield curve, the yield curve model is more so for like recessions, but if you're looking at the yield curve, that's definitely a red flag, and we cannot ignore this. Whenever we have an inverted yield curve and we're kind of looking at the version, that would suggest that it's overvalued. So for the yield, we definitely have to acknowledge overvalue based off of the yield curve. Yield curve is a good indication of a potential recession coming up. As you can see, every time we had that, we seen a major drop. So that is one of the biggest flags that I can see as far as overvalue, the inverted yield curve. We can't ignore that at all. Now, when we look at another way you can look at it is looking at margin debt, how much debt is into the market. Of course, since we know that interest rates are are increasing, so that the amount of debt that people is not as wise to use the particular debt. So if we're looking at margin debt as far as into the market, it's really low, obviously, because they could keep raising rates. So if we're looking at that, someone can argue it's close to, because once below this green line, this is kind of the way you read it. Once it's below this green line, we consider undervalued. So it's close. If we're looking at margin debt, it's pretty neutral within the fair range. So that one is fair as well. And if we look at the next up, we can look at the mean reversion. Which is the mean inversion? The mean inversion would show that, looking at the standard deviation plus or minus, that it would show that first the mean inversion, we're looking at. And by the way, they have the trend line where you can look at a trend line kind of linear and a flat line. So if you kind of just strictly looked at the flat line, you can be like, oh, clearly, overvalued. But if we're looking at the as far as the trend line closely, we can see that as far as the mean or whatever, it's slightly overvalued for the mean, slightly overvalued. So for this particular purpose, I just said for the mean inversion, it's overvalued. So when we're looking at it all together, for fair, so we have 4 fair valued and 2 overvalued. So overall, I concluded that the market is fair valued. One could even argue that we have 3 fair value, 1 undervalued, and 2 overvalued. So that's why I conclude that the market is fairly valued. Of course, if we have, the recession, profits will drop, unemployment raises and stuff like that, then of course the market will probably go much lower. So the market could go lower, but I was just kind of assessment as far as evaluations. So as you can see, we're still kind of on the, even though we're in fair value, we're still kind of on the high side. So the market does have, if you just kind of looking at, the overall average and stuff, the market does have room to fall. So it's not like it's a steal as far as the buy or something like that. It's in fair range, it's close to the high side. But if something does happen and rates, keep going up, you could definitely see that the market definitely has room to fall within the standard deviation ranges before it hits that historic level. So we definitely could see the market pull back a little bit, but right now it's still what I consider overall in fair ranges. Now, what I'm particularly doing, I'm particularly just kind of dollar cost averaging, just consistently investing to the overall market right now. Now, if we do see prices at like the S&P drop maybe like 10-15% again, or probably like 10% or something like that, I probably will invest more. But you got to remember, I'm looking at this is just kind of for the overall market. The S&P is a top 500 company. So in each individual sector, you can kind of look at that, and there may be buying opportunities. To me, the best opportunity that I would probably say now is definitely with tech, since they had a major fall. So I think if you look in tech, you can arguably find a lot more companies that could be considered undervalued, or close to that that fair value. So you could probably find room there, but the overall market to me is fairly valued. My strategy right now, I'm not doing any significant buy. I'm just kind of dollar cost averaging and just playing the long run. Now if I see that the market has, dropped significantly, I probably increase the amount that I invest as far as. But that's my strategy. Let me know in the comments below, what do you think about the assessment, and what do you think about the S&P, overvalued, undervalued? Make sure you let me know in the comments below. What do you think about the market, whether it's overvalued or undervalued? If you haven't already, make sure you hit the like button. If you're new, make sure you subscribe to my channel.